Hey guys, in this video I'll be diving deep into market cycles, including a look at Wyckoff theory and the stage that the market can be in. So without further ado, let's jump into today's video. If you've googled the term day trader, technical trader, day trading, you might see names such as Jordan Belfort, possibly one of the most well-known traders following the success of the film The Wolf of Wall Street, Mark Douglas, the man who broke down the barrier between retail traders and trading psychology through his book Trading the Zone, and you may be fortunate enough to see famous characters such as Ray Dalio, the trader and businessman who built a $1 million hedge fund from humble beginnings. But it's unlikely that the name Richard Wyckoff will appear at the top of your Google search. However, if Google really understood trading, they would likely have Wyckoff pinned alongside the other titans of technical analysis. Without further ado, let's take a closer look at the theories that Wyckoff developed on his fantastic journey as a technical trader. So you might be asking, if you haven't already gone to find out yourself after pausing this video, who is Richard Wyckoff, and ultimately, why should you take the time to understand what he has created? Well, to answer the first question, Wyckoff is one of the founding fathers of technical analysis and was born in 1873. By the time he was 15, he was in the pits running stocks for New York's brokerage firms, and in his 20s, he owned his own trading firm. So if that doesn't give you enough belief that he's a trading legend and has the ammunition in his arsenal to back up what he says, then maybe you need to rewind the video and actually have another listen. Before we delve deep into what the market structured principles that Wyckoff developed were, we first need to look at the 3 Wyckoff laws. The first law is that supply and demand determines price direction. If you aren't familiar with the term supply and demand, essentially, if there's a lot of supply, there's a lot of traders selling, hence supplying the market with the asset and therefore causing prices to decrease. We then have demand, which is the opposite. This is when there are a lot of buys in the market, which causes prices to increase. This may seem largely obvious, as the principle of supply and demand can be seen in almost every aspect of life that involves an asset-based transaction. But this is one of the keystones of the Wyckoff theory, and not cover this would just be criminal. We then have the second law, which is the law of cause and effect. This law moves more into the market structure, which we'll cover in more depth later in this video, but essentially this law provides investors and traders with an idea of the potential extents of a trend following a range. This is a useful concept for understanding targets when scaling out of intraday trades to capture bigger moves in the market. The final law is the law of effort and result, which essentially summarises that every action must have an equal and opposite reaction in price action. Now you know his laws, we can look at his concept of accumulation and distribution, which help expand your mind much further than the one-dimensional concept of the market either being ranging or trending. Let's take a look through the Wyckoff theory of accumulation and distribution using a rendition of this model that I've created that is based on the Wyckoff market phase model on TradingView. As we can see here, there are essentially 4 phases to this model, and as you will see later in the 365 Days of Forex series, I built a trading system based around some of the concepts that I'll introduce you to today. The first phase is the accumulation phase. During this period, the volume will typically taper off, and during this period, larger traders who usually struggle to enter the market with one single order will start to accumulate their positions. They do this by splitting their orders into smaller chunks and then accumulating these positions over a few hours, days or weeks depending on the size of the trade. It is during this time that the larger, smarter money will typically top up the percentage of retail traders that lose money in the financial markets, and by simply being aware that the market is in this phase provides you with a large edge when compared to a lot of other retail traders. Most people identify the accumulation phase as a trading range with a level of support and a level of resistance that will hold strong until the market breaks out from either side. Retail traders mistakenly think that they can simply short resistance and long support with no conscious decision making other than that very simple trading concept. This thought process is ultimately flawed, and this punting approach to the market is what allows institutes to increase their position sizing. As we can see from the diagram, the market will typically trade between the high and the low of the range and will occasionally pierce the selling climax. Those of you who've seen our video on Monday, order flow, will note this is very similar to a quad play candle, as it's diving straight for a pool of liquidity. Down there is likely to be a lot of liquidity as retail traders either enter as they see a continuation of the downtrend, or they'll have their stops here as they're looking to enter a buy trade as they were looking to get in on the reversal. As we all know, both of these scenarios provide selling liquidity, which larger traders lap up, as it means they can get a large chunk of their buy positions into the market. Following this, we will see a break to the upside, which is referred to as the markup. These moves are typically fast and impulsive, which shows us that there are larger trades in the market. If you miss the initial move, there are sometimes pullbacks that form wedges, which represent a pause, signaling bigger traders are either closing some of their positions or are capitalizing on retail traders' liquidity, who are typically trying to find tops by accumulating even larger positions. During the markup phase, we will see an increase in volume that is followed by a decline once price is nearing the buying climax, which you can see just here. Once the price gets to this point, volume is typically diminished significantly, and as a result of this, we will see the end of the markup phase. After the markup, the market enters a phase of distribution, which is the opposite of an accumulation phase. This is where the larger traders start to unwind their positions by using the retail traders to try and trade the range as liquidity. As we can see in this example, it is common that price will surge out of the distribution range, which is again another play from larger traders into a liquidity pool to take advantage of the naive retail trader. The process then ends with the markdown period after a break of the trading range. To get the best out of these concepts, it's important to remember that the markets are fractal in nature, meaning that what you see in one time frame may just be a part of the overall move on a larger time frame. Although the Wyckoff methodology denotes a change in trend following the markup phase, when trading the lower time frames, it's much more likely that a trend will continue following the distribution phase, as it will just appear as a pullback on the longer time frames. So now we've made it through the video, you might be a bit confused as to how you'll implement this strategy or idea into your trading system. You likely won't understand the concepts in enough detail to begin trading like an institution during these periods, and that is because you ultimately don't need to. You don't need to produce a trading system based around the Wyckoff methodology. Rather, have an awareness of these concepts, as it's extremely useful to have this in your trading toolbox to avoid any obvious rookie errors like too tight stop loss placement around levels. Later in the 365 Days of Forex series, we will be releasing specific trading strategies that relate very closely to the Wyckoff methodology. So guys, that was today's lesson on Wyckoff theory relating to market cycles. So why not head in the comment section below and let us know whether you've seen any assets following this exact same cycle discussed in today's video. Also guys, if you'd like the video, then smash that like button and be sure to subscribe. Cheers guys, and I'll see you in the next one.